Hello friends, Happy New Year all. In this session, we are going to discuss about the technique. We are going to discuss something important in this video where that will help us to identify the trend, identify the support and resistance, identify or determine the price extremes. It may even give signals when to submit our buy or sell order. Even in this video, we are going to discuss in detail about various technique used to identify the trend. What are we going to discuss? It's none other than moving average. When we discuss about moving average, we'll discuss about different varieties of moving average, which one is the optimal one, and what are the different lengths of moving average, why to select the appropriate length, and how to determine the trend, and various other options. Why are we waiting? Without much delay, come on, let's get into our session. Moving average. Moving average is the successful method of identifying the trend and profiting from the trend. Moving average again is the average of price for the past period, and moving average is calculated for every single chart period interval. If it is a daily chart, it will be calculated for every single day of the daily chart. If it is a weekly chart, it will be calculated for every single week of the weekly chart. It dampens the effect of short term oscillation. If there is wide movement in the price, it dampens, it gives an average price for better identification of the trend. Similarly, it the usefulness of the moving average, you are pretty much right now aware. It helps us to identify the trend. Moving average is tested to have statistical significance and moving average crossover. What is moving average crossover? Shortly, I'm going to explain that. Moving average crossover have intrinsic value. Simple moving average is calculated on the close price. The recommended option is to use the close price for calculation. However, as per theory, we can use highs and lows as well for simple moving average calculation. What is the formula for simple moving average calculation? You can see right here the formula for simple moving average. It is day 1 close price plus day 2 close price plus day 3 close price, go so on and so forth till day 10 close price. We are calculating 10 days simple moving average divided by 10. It will give the moving average for 10-day period. Simple moving average for 10-day period. Let's see the calculation. Here, right here, this for day 10, day 1 to day 11. Right here we have day 1 to day 11 observation. In column E, I have open price. Column F, I have high price. Column G, I have low price. Column H, I have the close price. If I am calculating the 10-day simple moving average, I'll take 10-day closing price highlighted in green divided by 10. 10. As simple as that. You can see the formula as well here. Once we arrive at the simple moving average calculation for day 10, similarly we'll calculate it for further day 11, day 12, day 13, etc. as well. Once we arrive at the simple moving average, we'll plot it in the graph. This blue line is a simple moving average. For upward trend, the simple moving average will be rising upwards. If the simple moving average is falling downwards, the trend is downwards. Moving average is a lagging indicator. Why it is mentioned as lagging indicator? If you observe here, the price turned upwards. However, the moving average is turning upwards little later. Right? This is the reason why we call moving average as lagging indicator. Simple moving average is also a lagging indicator. Similar to simple moving average, there are other types of moving average as well. Let us see one by one. Right now we'll see linear weighted moving average, LWMA. What is the difference between linear weighted moving average and simple moving average is the linear weighted moving average give more importance for the latest price. This is the formula for the linear weighted moving average. We can see this formula with an example. We'll take the closing price. Right now, we are going to calculate linear weighted moving average for 5 days. We'll take the closing price for 5 days. Closing price for day 1 is multiplied with 1, and closing price for day 2 multiplied with 2, closing price of day 3 multiplied with 3, so on and so forth, with closing price of day 5 multiplied by 5. This is for the numerator. And in the denominator, we'll add 1 plus 2 plus 3 plus 4 plus 5, and the numerator is divided with the denominator. The resultant number is the linear weighted moving average for 5 days. The next moving average we are going to discuss is exponentially smooth moving average. When we calculate simple moving average, we have an issue of drop off effect. Meaning, when we are calculating 10-day moving average for 11th day or 12th day, we are supposed to drop off the day 1's closing price and day 2's closing price depending on the day on which we are calculating. Okay? If it is a 10-day SMA, if we are calculating the 10-day SMA for day 15, the closing price from day 5 to day 15 or day 6 to day 15 will be considered. All the previous closing prices were ignored. It may have a negative impact or it may have an impact which is called as drop off effect. To avoid the drop off effect, we use exponentially smooth moving average. How we address the drop off effect? Large weight is given on the latest price. Because of that, EMA will change direction more quickly. We'll see EMA in the chart in a moment, but we'll review the formula right here. Let me explain the formula with an example. We are calculating exponential weighted moving average for day 11. Right? So in this, there are four components in exponential weighted moving average. Number one, we have a weight for the current price. Number two, we have the closing price, current closing price. And number three, we will calculate a weight for the past prices or past EMA, and we'll have a past EMA or last EMA, whatever it is. How we'll calculate the weight for the current price and how we calculate the weight for the past EMA. Weight for current price, that is, we are calculating moving average for day 11. So weight for the 11th day equals to 2 divided by the number of days in moving average, 10 plus 1 equal to 0.1818. Right? And weight for the last moving average is 1 minus this figure, 0.1818. We'll arrive at 0.8182. 8182 goes here, 0.1818 goes here, and we'll arrive at the moving average. You all pretty much know there's no need for calculation. These days we are not calculating. We'll use the charting system. The charting system automatically plots the moving average for us. But just for examination purpose, we should be aware of this formula and understand how exponential moving average is calculated. The next method is Wilder method. In Wilder method, it is also similar to exponential moving average EMA, weights the most recent number more heavily. Wilder method is specifically used in average true range, relative strength index, directional movement indicator, etc. We already discussed about ATR in the past. For RSI and DMI, shortly we'll be discussing about that. And again, we'll discuss about Wilder method using a example. Wilder moving average for day 14, how it is calculated. We'll get there are three components here. Number one, number of days. Number two, the last or latest moving average. Number three, closing price. Okay? The last moving average is multiplied with 13. Right? And closing price for the current day is arrived, or we are aware of closing price for the current day, and divided by 14, which is the number of days for which we are calculating the Wilder moving average. Here I have SMA and EMA. If you observe here, SMA is in blue in color, EMA is in red in color. The EMA reacts to the price pretty earlier compared to SMA. So here there is a price change, movement upwards. There is a movement upward, and SMA reacted later, but EMA reacted little earlier. This is called as drop off effect because SMA calculates for a specific number of periods. Here I calculate the SMA for 20 days. So only for the price for 20 days considered. All the previous prices were ignored. That is not the case for EMA. Let us add Wilder's moving average. I'll take off. So the red one is exponential moving average. Green one is Wilder moving average. Most commonly used moving averages are simple moving average SMA, exponential moving average EMA, and worst case we use Wilder moving average. There are few more moving average we should be aware of as per our theory. The next interesting moving average we should be aware of is geometric moving average. This is mostly used in indexes. This is the formula to calculate geometric moving average. This also has a problem of equal weight and lag. And next moving average is triangular moving average. This is similar to simple moving average, but once we calculate simple moving average, we'll perform another simple moving average on top of the existing simple moving average. For example, if we calculate 10-day simple moving average for day 1 to day 10, then we'll have, in addition to the closing price for day 1 to day 10, we'll have simple moving average for those as well. So in addition to, instead of the closing price, we use simple moving average for those 10 days and divide it by 10, or maybe as per the theory, we'll take half the length and we'll divide it by 5. Then we'll arrive at triangular moving average. It better represents the trend. Double smoothing also detracts from its sensitivity to trend changes. There are few more moving averages named as variable exponential moving average. This is same as exponential moving average, but the weighing pattern or weighing scheme is based on the volatility. Because when in the trading range, volatility is narrow and we may end up in whipsaws. To avoid that, the weighing scheme is based on volatility. Few of the variable EMAs are Kaufman adaptive moving average, which is calculated based on volatility and trend, and volume adjusted moving average. It emphasizes those bars with higher volume. Similarly, we should be aware of adaptive moving average, MAMA, and following adaptive moving average, FAMA. In this screen, you see two moving average. The red line is the simple moving average for 20 days, and thick blue line is simple moving average for 50 days. The length of moving average has some significance. If it is a longer time period, for example, the thick blue line for 50 days, 50-day moving average, it includes more data observation and it has more information. Number two, with more data, each day's data become relatively less important in the calculation. Number three, a large change in the value on one day does not have a large impact on the longer moving average. And here there is a change, but there is lesser impact on the longer moving average compared to shorter moving average. The trend is slower. The shorter moving average moves quicker. The change it adapts to the price and moves quicker with the price. But the longer moving average is slower in pickup in trend. And even it gives less false information. For shorter time period, the red one, the potential of giving a false signal of a changing trend direction is high. When we use multiple moving average, support and resistance level occur when two moving average cross. Right here, the red one crosses the blue one. So support and resistance occur in this place. And what is a buy signal? When the shorter moving average crosses the longer moving average, it's a buy signal. And what is a sell signal? When the shorter moving average crosses below the longer moving average, it's a sell signal. This is not a real sell signal, but just for theoretical purpose, that is the case. Why this is not a sell signal? Because moving average is trend following technique. Here we see sideways movement. In sideways movement, moving average never works. Short-term moving average can also be used as trailing stops. So when I place a buy here and when I use short-term moving average as a trailing stop, I can sell it right here. What is directional movement? We all pretty much aware moving averages works only in trending market, right? So to identify the trend, when is the market trending? What is the direction of the trend? For this purpose, we use directional movement. It's a great contribution by Wells Wilder. Wells Wilder, he compares the stock's trading range for one day with the trading range on the previous day to measure trend. For a specific day, if the current bar is below the previous bar, it will be considered as negative DM. The difference will be considered as negative DM. The end of low of current bar to low of previous bar. And similarly, in case if the current bar high is above the previous bar's high, the difference between current bar's high and previous bar high is taken and considered as plus DM. If we have inside bars, no DM is calculated, no directional movement calculated. If it is outside bar, calculate the difference between current low and previous day low. Calculate the difference between current high and previous day high. Whichever is higher is considered as DM. How to construct directional movement indicator? Now we have DM plus and DM minus for different days. The moving average is calculated for both plus DM and minus DM using the Wilder method of averaging. Number one. Number two, 14-day average trading range is calculated. How to calculate average trading range? What is trading range? Explained in the previous video or in the previous chapter. The third point, two indicators are calculated using this data. This blue one, which is plus DI or directional indicator, positive directional indicator. The red one, which is negative directional indicator. The positive directional indicator is calculated with smooth plus DM in the numerator divided by true range in the denominator, which will tell us the percentage of true range that was above the equilibrium for those many days. Negative directional movement indicator, the red one, how it is calculated? Smooth negative DM in the numerator and true range in the denominator. With that, we arrive at negative directional movement indicator. Envelopes, channels, and bands. Moving average represent the center of the stock's price trend. By determining the band within which prices tend to oscillate, the analyst is better able to determine the range in which the price may be expected to fluctuate. Percentage envelopes. The usage of percentage envelopes are it attempts to reduce the numerous unprofitable signals from crossing a moving average when the trend is sideways. What is the calculation method for percentage envelope? Just take a percentage, add it on top of the moving average and deduct it from the moving average. It will create a percentage envelope. When price crosses the envelope, it triggers a buy signal. When crosses below the envelope, it creates a sell signal. What is the limitation for percentage envelopes? We are actually using a fixed percentage to calculate the envelope, right? Fixed percentage above the moving average, fixed percentage below the moving average. It does not account for volatility, which is a limitation. Bands envelopes around the moving average rather than being fixed in size, are calculated to adjust for the price volatility around the moving average. They shrink when prices become calm and expand when prices become volatile. The one right now, what we are seeing on screen is Bollinger Band. How it is calculated? The upper band is calculated by adding two standard deviation on top of simple moving average. The lower band is calculated by reducing two standard deviation from simple moving average. The bands are self-adjusting. It becomes wider during the calm period and expand during extreme price changes. Keltner band or ATR band. How Keltner band is calculated? Number one, calculate the typical price. How to calculate the typical price? Typical price equal to close plus high plus low divided by 3. Number two, calculate 10-day SMA of typical price. Number three, this is for calculating the band size, the upper band and lower band. It will be 10-day SMA of high minus low. In other words, we can call it as bar range. Now we have typical price. We have SMA of typical price. Now we know the band size as well, which is calculated as 10-day SMA of high minus low. Number four, the upper band is calculated with 10-day SMA of typical price plus 10-day SMA of bar range. The lower band is calculated with 10-day SMA of typical price minus 10-day SMA of bar range. Another band is start band, STARC band, Stroller average range channel, another term for it. Upper band in the Stark band is calculated with 5 period SMA plus 5 period ATR. The lower band is calculated as 5 period SMA minus 5 period ATR. ATR comes into picture here. Channel. Right now what we are seeing is Donchian channel. Donchian channel encompass the price action. Signal, when buy signal happens when the price crosses the highs for the past 4 weeks, and the sell signal happens when price crosses the lowest for the past 4 weeks. Donchian channel is mostly applicable for commodity market where price tends to trend. Thank you for your time. See you in the next video. Please note to subscribe to my channel. Thank you, friends. See you. Bye bye. Happy New Year again.